Hey, this is Chris, and in this video I'm going to be talking about how to buy shares in Australia on the ASX. Now, the Australian Stock Exchange has a huge range of different investment options. It's a supermarket of options. It includes direct shares, which are known by a lot of people, to listed investment companies, which are a way of buying active funds, to managed funds, to real estate investment trusts or REITs, to ETFs. So there's a whole bunch of things that you can buy on the ASX that will give you exposure to underlying shares. In this video, I'm going to be talking about how to pick the right ones. And there's really three questions I think you need to be asking in order to determine that. So there's a range of reasons why people invest, and this is the first question you should be asking yourself. Why am I investing? Now, the two most common reasons I would see out there is a lot of people invest to learn and to get experience and to discover companies and to make it a bit of a hobby. And if you're investing for that purpose, probably the way that you're going to want to go about it is by setting up an online account with a stockbroker, because that's going to allow you to easily buy and sell shares and discover all of the different companies out there and do your own research. Some of the more popular online stockbrokers in Australia are brokers like CommSec or NabTrade or SelfWealth. This will allow you to get a bit of experience, but you should keep in mind that if your aim is to make money and grow your wealth, then this probably isn't the right option. Statistically, people that set up accounts with online stockbrokers don't tend to do that well if they're buying direct shares. That's just because of the mathematics of the market. Only a very small number of shares actually give you good returns, and the majority do pretty poorly. So most people's experience if they set up an account with an online broker is that they do get experience and they learn, but they don't tend to make much money, and most of them actually lose money. Now, the other option is, if you're actually looking to build your wealth, then probably investing into a basket of shares is the smarter option. Diversifying is a safer way of investing and actually is proven to give you a better chance of growing your wealth over the long run. And if you're looking to do that, then there's different options out there, including listed investment companies and ETFs are probably the two most common. We've done an analysis on our StockSpot blog, which I'll put a link to below, on how to compare these two. But ultimately, we found that for most people, ETFs are the superior option. However, if you're going to try and do it yourself to learn, it's going to be quite difficult because you've got to compare now in Australia over 200 different ETFs. You've got to work out what are the attributes you're looking for, what are the costs you're looking for, what are the mix. What's the mix that's appropriate for your investment horizon, when to rebalance your portfolio. So there is a lot of work to do, and it's not just as simple as picking a couple of ETFs and throwing them in your portfolio. Now, if you've decided that your aim is to grow your wealth, the next question you need to be asking yourself is how involved you want to be. And there's a range of different desires here. Some people want to be actively investing, checking the market every day, researching stocks. And if that's what you're after, then probably setting up an online account with an online stockbroker is still the right option for you, because that will give you that ability to be really involved, and it will take a lot of time, and for many people it takes tens of thousands of hours before they can really become confident that they can be a great investor. But setting up an online account is probably the right way to go about that. On the other side of the spectrum are people who want to be not involved at all and outsource the managing of their portfolios, which is another good option. There are a few ways you can go about this. You can go and find a traditional advisor or stockbroker, and they can manage the process for you. The downside of that process is it typically costs a lot. Going through one of these old school advisors or brokers, and you're going to pay brokerage costs and platform costs and all sorts of other fees, and typically those costs really eat into your returns, which is why the other option, if you want to outsource these days, is to use an online automated service. This is a service like StockSpot, where we actually take the hassle out of investing for you, but try and keep your costs as low as possible so more of your returns stay in your pocket. But at the same time, we're picking all the right investments, we're rebalancing your portfolio, we're working out what's right for you all the time. So finally, the last question you need to be asking is, how do you want your investments to be owned? And this might not be a question you've thought about, but there are ultimately two different ways that your assets can be owned in Australia. The traditional way in Australia that most stockbrokers use, like CommSec and NabTrade and even businesses like StockSpot, is that your assets are held on what's known as a HIN. Now, this is an individual number that you have at the exchange that identifies your holdings and ultimately means that they're very safe. if anything were to ever happen to your stockbroker, it doesn't matter because your assets are held actually on a HIN at the exchange. So it gives you that confidence, but also it gives you the portability of your investments in the future. So if you decide to move somewhere else to a different broker or a different advisor, you can do that without realizing capital gains, which is a huge benefit, especially if you have a lot of profit built up, because you don't want to be paying tax on that. The other option when it comes to ownership is actually going into a commingled structure. So this is where everyone's assets are held together, either on a single HIN or in a custody account. Now the safety really varies a lot and it will depend on who you go with, but the benefit of this is that costs tend to be a little bit lower. The risks are that you no longer have the assurity of your investments being held at the exchange, and you have to rely on the custodian or the partner you're working with to safely manage your assets and keep them separate to everyone else's. And unfortunately in Australia, there are a lot of historical examples of businesses that haven't done that well and have mingled client assets and ended up losing assets for clients. So I'm very cautious about this way of owning assets in Australia at the moment, and it's not something we'd recommend to clients. It's ultimately not what we offer to clients, but it is available out there. Options that offer this include some of the CFD providers in Australia, and also some of the newer stockbrokers like Superhero. So to wrap up, the ASX is a supermarket of different options when it comes to how you can invest, and so it really pays to sit down and think about what you want out of your investing first, because that will ultimately help set up how you're going to go about it. I'd be asking 3 questions. 1, why are you investing? Is it a hobby? Is it to learn? Or is it really to grow your wealth? The second question is how involved do you want to be? Do you want to be in there buying, selling, making trading decisions, researching, or do you want someone else to be doing that? And the third one is how do you want your investments to be held? Do you want them to be on an individual HIN where you have the legal and beneficial ownership of them, or do you not mind if they're mixed up with other investors? Ultimately, if you can answer all of those, it will put you on a good path and help you be a great investor. I hope this was helpful, and good luck in your investing journey.